So I work for Smith-Midland. I'm the CFO, Secretary Treasurer. The company's been in business for about 60 years. We do precast concrete products. So we manufacture, we sell, we license, we rent that. And if you don't know what precast concrete is, it's concrete that is made in a facility and not poured on site. So if you're ever driving down the road, you'll see a concrete barrier, and most likely that came from either our plant or one of our licensees' plants. So the company was private for quite some time, and then in 1995, the company determined to go from a debt structure to an equity structure and did the IPO on NASDAQ. And then in the early 2000s, we were delisted from NASDAQ, and we've been on OTC ever since. Back in 2015, we met the criteria of the top, it's roughly 450 out of 10,000 OTC companies to be on their OTC QX platform. And it has been tremendous for us. It's been a great place to get some liquidity for our investors. So I guess that's kind of our story, and we'll get more into that. So Dave, I think you're next in line alphabetically.
All right, thank you. Thank you, AJ. My name is David Wagner, President and CEO of Zix Corp. Zix is a leading provider of cloud email security, productivity, and compliance solutions for businesses of all sizes. We service about 30% of the hospitals in the United States, 31% of the banks and credit unions. So the mid-market buyer of compliance-oriented solutions is really the market vertical that we're focused on, the customers that we service. We have about $214 million of annual recurring revenue, about 540 employees. We just celebrated our 30th year on the NASDAQ, so quite an old public company for a micro-cap company. We raised $100 million in the late 90s to get the company started. We ended up buying back shares over the late 2000s, 2009 to 2015. And then last year we raised $100 million in a PIPE offering. Our passion right now as it relates to the investment community is ESG. We've spent a lot of time thinking about ESG, working on ESG, and have earned the ISS ESG Prime designation as a company in the top decile for ESG. And so looking forward to talking to you more about the issues we face as a long-time public company. Marianne?
Sure, I'll get started. So Howard Bank is a $2.5 billion bank headquartered in Baltimore. We're very focused on people and place. So we work with SMEs, small and medium-sized enterprises that are based either in the greater Baltimore region or in the greater Washington areas and Philadelphia areas immediately contiguous to those. So the irony in our business model is that we focus exclusively on privately held, very often family-owned businesses. Started the bank in 2004, so we're a young company, and became an SEC registrant in 2012 and listed on NASDAQ at that point in time. We've done a couple of capital offerings, two independently, one associated with an acquisition, and we've also grown the capital base that you need for $2.5 billion in assets through some whole bank acquisitions. But while we are focused on and respectful of family-owned businesses, we decided in 2012 that we needed to be an SEC registrant in order to have access to the kind of capital that you need to be relevant to business owners, impactful in your community, and in order to be totally transparent. A number of banks that started early in the 21st century had a strategic business model that basically went along the lines of, we'll start, we'll raise some capital, and then we'll sell. And we wanted to have at least the option to do something other than that for a longer term basis. And so we needed to focus on optionality for our original shareholders, a way for them to, on their own and on their own time frame, to liquidate their investments and make those initially illiquid investments more liquid. We've been very happy with the SEC registration and with the public world. We're a highly regulated company, and so that means some of the quarterly requirements and the transparency just comes naturally by virtue of being a regulated industry. But we believe it's given us that access to capital. It's given us that transparency that our shareholders want. It's given them the optionality. Clearly, as a micro cap, that doesn't mean that you necessarily have the liquidity that sometimes your shareholders want. But that's something that we believe is ultimately, again, on an optional basis, only available as an SEC register. So I don't know how David and AJ, I know a little bit how you've experienced the liquidity challenges of micro cap. But, you know, I'd ask you to comment on how you found that challenge.
Yeah, I'll go ahead and take that. So for us, you know, we're $50 million in revenue. So, you know, the word micro cap takes on a bigger and bigger company every year. So we're in the nano cap space is what we call it around here. So, you know, you talked about raising money, but, you know, as I said, we're on OTCQX, which is a secondary trading market. So it's not really a platform for raising capital per se. We just have it because there's a little bit of liquidity for our investors, but it's a major challenge. It being so small, you know, we're trading, our average daily volume is roughly 5,000 shares. So it's not a lot. You know, it takes a long time to get in a big position, and it takes a long time to get out of a big position. So definitely a lot of challenges there being in that nano cap space. What about you, Dave?
Well, you know, so we're a step up from that, but still very much in the microcap space. Our maturity has allowed us to get some analyst coverage, which we have about 6 covering analysts now, which is certainly helpful. But the market has changed so much. I was a public company CFO for more than a decade, starting 10 years ago. And what I noticed coming back into the public market in 2016 is how much the ETFs and the algo traders have changed the complexion of what we are facing in the public markets. And so the volatility that is sometimes created by those phenomena where we get basketed in with cybersecurity stocks or basketed in with software stocks, and then as a small company get moved around sometimes disproportionately as those positions move, creating a lot of volatility. So you know, we've had a great experience being a publicly listed company for a long time, but one of the challenges we're facing now is this the volatility as the character of the shareholder base has changed.
Yeah, I think it's an interesting perspective. I mean, because of the growth that we've had, are close to a 200 million market cap, probably around 186 now. But one of the interesting dynamics of our market capitalization is that the last acquisition that we did was of a privately held company that had recapitalized themselves a few years before, and it relied new institutional investors or private equity. So first of all, our market cap has been impacted by any very large shareholders. And yet we found those large shareholders and the traditional institutional shareholders, plus our original retail shareholders going back to 2004 and going back to one of the companies that we bought that had a retail shareholder base, have helped to offset that general trend. But we've certainly seen in the last year, let's call it the good and the bad of being in an index for a Russell 2000 company. And the good news is that does give us more visibility. We're covered by about 4 institutional analysts. And that also gives you more of a platform for liquidity. But the minute you're in an index, you're now beginning to be part of those index funds and in turn part of the index. And what we've seen in the last year, and in particular with the challenges of the pandemic, is the ETFs are playing a more and more dominant role, I think, in all of our lives. And that is difficult because basically it means that rather than having institutional or retail shareholders who can take that transparent information you give them, parse it, talk to you. We're obviously very accessible, both as a microcap and as a community bank. But the ETFs are not talking to you. They're basing all of this purely on a group of metrics and, to your point, David, on industries rather than on the unique characteristics of a company in an industry.
Yeah, and maybe a derivative of that phenomenon, Marianne, we're talking about is the proxy advisors then, and how many of the votes are driven by proxy vote. How are you finding that in your business?
Well, we've been challenged, and we've never had a proxy advisor who's done anything other than support our proposals. But having said that, I think that I would agree with one of the previous panelists who indicated that there are now some institutional investors, not all, but some, who have completely abdicated their own role, again, in analyzing the specifics of your governance. They're looking at a chart and they're checking boxes. The proxy advisors, I think, theoretically provide a very useful role, but I think that the way that they execute occasionally leaves a lot to be desired. You tend to have sometimes very junior people, again, using more of a checkbox formula rather than an actual analysis. There are a lot of rules around whether or not and when and how you can speak to proxy advisors. Again, we're not built as a company to not be able to talk to our stakeholders. And the proxy advisors at this point are stakeholders. And I think there are also some conflicts that some of the proxy advisors have in terms of additional services and analyses that they would like to provide, but understandably their business model doesn't allow them to provide that free of charge. And so there are some potential elements of conflict. So proxy advisors for us, part of the game. We're happy to be in the game. I think sometimes the execution leaves something to be desired. And I know that the SEC is going to be playing more of a role going forward in providing them with the same sort of boundaries that they provide all of us, which we think is a good thing, and we've been supportive of that.
Yeah.
Hey y'all, this is Julie. We've got a question that I wanted to lob into you. We've had a couple folks ask about the fact that the SEC's reporting regime provides for some areas of scaled disclosure for smaller companies such as yours. And I know you talked a little bit about that opportunity to scale. But we got one particular question asking if you view any of the requirements as being out of whack in terms of the shareholder value it drives, whether there's maybe some other areas that you would like to see scaled, or if you think they're appropriate.
AJ, you're the smallest in terms of market cap. What would your thoughts be?
Yeah, so, from us, I'm in a department with 5 people. So, it all falls onto my lap. I wear, I'm CFO, Secretary, Treasurer, IR, you name it, I'm there. I'm on the production floor. So it can be a burden being as small as we are. However, I will say a lot of the disclosure that we put out there has drawn a lot of investors. So just the MD&A that's required, that actually does help us quite a bit, because a lot of times if I'm on the shop floor, an investor's going to call in and I'm not going to be able to answer the questions feed, right? So for us, even though it's a burden, I think it is a very useful tool, filing quarterly, all the required filings. But, as again, I have all the same filing requirements as, Dave and even bigger companies. So that is fairly tough.
Yeah, it's not so much the scaling. I think it was Marianne that really emphasized this. Transparency is something that we're moving to a more and more transparent world, and so we recognize that Zix, and we're embracing that at Zix, and we serve compliance-oriented buyers, and so they want that transparency from us. But it's more the changing regulations that in accounting practices, when they change, it creates a lot of extra work. And so I think there are a lot of things that the FASB thinks about, and they think it's going to help shareholders, and maybe it does. Lease accounting rule changes and run team back through, every contract we have, and sales compensation, ASC 606 changes. It's the changes that put the bigger burden on the team that I find. And I wonder if sometimes we don't just change for change's sake, as opposed to recognizing the value of being consistent and following through and letting companies mature into the processes. It's the change in processes is what stresses my team.
So David, I would agree, but let me ask if you agree with this. I think it's less the fact that the SEC registration requirements are that you need to report quarterly, and I'm always very appreciative of the small issue or exceptions. I could make some distinctions that I know, again, we file quarterly reports for our regulators as well, for the FDIC. They have some interesting rules on their quarterly call reports where some things are only reported every 6 months and some things are only reported annually. So there's a skeleton of the information that's always going to be useful to an institutional investor, but other pieces that might be reported less frequently. So it lets you toggle that balance between transparency and the cost. But I would agree with you, and I think that the fact that the SEC provides information quarterly isn't in and of itself a challenge. It's what goes with that. I mean, we've had many sudden changes, or long anticipated, but perhaps unwise changes that FASB has imposed on our industry as well. And it's those changes, rather than the fact that you have to report them quarterly, that really drive a lot of the issues. And then it's also, what do some people do with that quarterly information? And some of the previous panelists talked about this, but the expectation in some quarters that you're going to give earnings guidance, which tends to make you very short-term oriented unless you're passionate about resistance. And we do try to focus very much on a long-term strategy. But it can be difficult when you're providing not only quarterly retrospective information, but you've got people that then want you to take out your crystal ball and tell them what's going to happen 6 months from now. So it's the unintended consequences rather than the reporting itself, I think. And I think that's what you're saying in terms of the FASB rules as well.